Hi, there is those who win in Forex trading, and then there's those who lose in Forex trading. What is it? What is the one thing that winners know about Forex trading that losers don't know? Or probably, what is this one thing that winners know and respect that losers probably know and they don't respect, or they don't pay attention? I'm not sure whether you guessed it right, but if you did, then that would be risk management. Today and in this podcast, we're going to be covering risk management, and this podcast is brought to you in partnership with FXPesa, which is a subsidiary of EGM Securities. And probably George might dig into this and let guys know about risk and what we're about to just dig in.
Oh yeah, so everyday life activity is fraught with risk. You tuning in, listening to this podcast is a risky endeavor. You don't know whether you will get value for your time or you will actually get value for your time. Going to work is a risk. Putting up that job application is a risk. So everyday life is fraught with risk. So once you know that, you then need to know how to deal with risk. You need to know, how do I manage this risk?
True.
So like energy, it can't be created, it can only be transferred.
True.
So risk is there. You can't do without risk.
True.
So the only sensible thing to do is to deal with risk.
True.
And now this introduces the topic of risk management. How do we manage this risk? So I'm just going to give you a layman's definition of the word risk, okay? So in simple terms, risk is just the possibility of suffering a loss. Whatever loss is, in your own words, as long as you deem anything is a loss to you, the possibility of that loss occurring is risk.
Is risk.
Yeah.
Does it mean that as you were taking the shower today in the morning, you were quite aware that you might not, leave that shower probably, and you still went in there, yeah? Why? Because you so badly wanted to do this podcast? Is that so? Did that outweigh the risk of whatever could have happened in the shower?
Oh, yes, definitely. If you've been watching 1,000 Ways to Die, you must have seen a couple of guys die in the shower.
All right. I'm just going to cut you right there because you're not going to do a movie review in this podcast. Okay. So what is it about Forex trading that really makes risk management a must? The first thing that traders must understand is that trading is about speculation. Trading is based on the statements of if, then. So if this is the signal, if this is the price action setup, then I'm going to pick a trade at this level. And if I'm wrong, I'm willing to accept that I'm wrong. Yeah. And one way that traders accept that they are wrong is by respecting their stop losses. One way that traders accept that they could have been wrong is by establishing a certain percentage of their capital, which they set out to risk in a single trade and which they stick to. Yeah. So that is what we're going to be covering today. And I think we just dig right into it, George. Yeah.
Oh, yeah, sure.
So the first thing that traders really fail to respect is setting up a maximum exposure, like a percentage of your trading account, a maximum exposure that you're going to be exposing your capital into the market. The question of the how much really depends on individual traders, but as we advise students and as we outline in our Forex trading course that we offer at FourthStreet Consultants, we advise especially newbie traders to set out about 4% to 5% maximum exposure to the market of their capital. That means that if, for instance, you have an account of $1,000, then your maximum exposure in all your trades, then totals to 5%, which is $50 at any one given time.
Yeah.
So I think, George, you can maybe just dive into now, how do you go into the specifics of how much do you risk now per trade, and how many trades do you execute per time, and what guides you into, allocating the 5% across the many trades that you'll be doing.
Yeah. So imagine you've just gone for shopping, okay? You need A, B, C, D, like 5 items or 10. All that depends on your level of capitalization. So it's the same way when you're coming to Forex. We've just talked about you need to know your maximum exposure. So when you go shopping, you need to know, I want to buy 1, 2, 3 things, but how much is available for me to buy all these things? You don't just go and wing it in the supermarket. Otherwise, you'll end up spending on things that you did not want to spend.
They call it impromptu.
Exactly. Or impulse buying. So knowing beforehand that I want to buy this much, using this is the stipulated amount of money that I need to use, is the same way that you need to know, out of my $1,000, I am only willing to lose a maximum of 5% at any given point.
At any one given time.
Exactly.
Yeah.
So then, how do you divide this 5%? Okay. So again, back to the shopping example. What do you need the most? What can you do without? Okay. So when you're listing your items for shopping, you will definitely begin with the most important. Okay.
I would go for a need.
Exactly, not
As
a
opposed
want.
Exactly.
A need. What do you need the most? So when you're scanning through the markets, you're scanning through the charts, okay? There are some setups that you will see. Well, this also comes with a level of experience.
True.
We call it position sizing. How do I size this position? Okay? So you really need food. Definitely you will put food on your shopping list, okay? Yeah. So depending on whether you're a vegan or you're a meat eater or you don't care or whichever.
All right.
So if food is what you need the most, then you will probably spend more on food than other items.
Makes sense.
So if this opportunity that you just scouted on the market is an A+ setup or is a setup that shows market confluence, like we do.
Oh, that's a big one you brought in there.
Yeah.
Market confluence is one of the most powerful setup any trader can take advantage of. Market confluence is a whole topic on its own that we're going to be covering later on in the future episodes of podcast. What a confluence means is certain scenarios in the market have converged at one point. Probably there's support, there's resistance, there's a price action setup, one or two converging at the same spot. Like the odds are too good for this trade that I can't miss out. And that also goes forward to answer the question of how do you distribute the 5%, the maximum exposure across the various trades. So let's say, for instance, you have two opportunities to trade. One is in the Euro USD pair. The other one is in, the USD Japanese yen pair. Okay. And the Euro USD pair offers you a perfect confluence setup, which for us price action traders, we view a confluence as a more powerful price action pattern that is bound to happen. Remember, we're not sure it's going to happen, but it's a confluence. And so if I had my 5% and I'm thinking to distribute this 5% across these two trades, it would be really logical for me to assign the confluence opportunity or price setup 3% and then offer the other price setup 2%. The other point that can guide or should guide traders into assigning the risk amount that you distribute to the various trades is the risk to reward ratio. Yeah.
Now, that's another whole topic, Just so you know, trading confluence is expounded in depth in our online trading course, FourthStreet.co.ke. That's where you get any educational material on trading. Now, risk to reward. So just like it says, what are you risking vis-a-vis your rewards? Okay, what do you stand to lose against what you stand to gain?
True,
okay,
true.
So
it's a numbers game.
It's a numbers game.
Yeah, and numbers don't lie. Remember,
they never lie.
They never lie.
Yeah. So risk to reward simply means this is one of the answers to people who ask, how many trades should I take for me to become profitable?
Yeah.
The answer is what is the nature of the risk to reward of the trades that you take.
True.
If your trades have a multiple risk to reward, then you do not need to take many trades in order to be net positive. Okay.
Yeah. Perhaps we can go forth to expound risk reward. In case you're listening to this podcast, you're locked into the podcast, you don't know so much about trading, you're looking to get into trading. Risks to reward basically means, let's go back to the math. So we have $1,000 account and our risk exposure is 5%, and we assign 2% to one trade out of the 5%. Okay. 2% of $1,000, right? That's $20. Quick math. So what this means when you talk about risks to reward, it means I have located or I have spotted a price setup that gives me a greater reward as compared to the risk. So if I'm risking $20 in this trade, I must have analyzed the trade and seen that this opportunity is bound to give me ×2 or ×3 of my risk amount, which is $20. Yeah. So the only reason I'm taking this trade is because I'm risking $20 to get $40 or $60.
Sure.
The power of math and compounded profits. And so actually it's very interesting because this is the basic truth.
Yeah.
If a random guy comes into the market with proper risk management rules, and these guys have no clue about Forex trading, and they take 20 random trades, but they do that while respecting risk management, following their risk amount, and making sure that every trade has a risk to reward ratio, which is greater, equal to or greater than 1 to 2.
Yeah.
And you as a professional trader, or you claim that you're a trader, and you don't respect risk management, guess what? These are the guys going to beat you.
Oh, yeah.
This guy will beat you. A random nature of choosing trades without any specific skill, by following risk management, this guy is going to beat you squarely. This is how powerful risk management is. And it's a subject that a lot of traders tend to ignore because it's boring. People want to talk about the right entry. People want to jump into the next trade. People want to make this quick money that makes them feel good, that they can talk about their friends about how much they made today. But us as FourthStreet Consultants, we're more careful about your long-term performance, not about today. What about 3 months from today? Yeah. Because we teach guys to approach Forex trading as a career, as a sustainable career. Because guys like me and you, for instance, talking for my case, I've never been employed. Okay. I've been doing this for the last 12 years. And so when we talk about Forex trading, risk management, and all this, we are so enthusiastic about it because we know what it means to learn the skill in the right way. And throughout our course at FourthStreet Consultants, this is how we approach Forex trading and how we teach guys to approach Forex trading as a business. Yeah. So
what I'm just getting from your explanation is risk is what will keep you in the game, right?
Sure.
So this is like, well, another analogy just came to mind. This is like a boxer learning all the skills there are in boxing, but you have no gas tank.
Oh.
You can throw all the punches, all the punches in the book, but you can't last a few minutes
in the ring.
So a guy with no skill whatsoever, but with a gas tank can easily take you out.
Knock you down, true. Okay. Perfect one. Then there's another element that I think is usually tricky for guys. Well, in any business setup, you've got to put in some risk for you to realize gains or profits, right? But it's usually very tricky for traders, the balance between should I risk too little or should I add to my risk? Because again, especially for guys who do this full time or even guys who do this part time, well, if you risk too little, then it means even if you get a win, the amount of dollars that you make won't be as significant as much. Yeah, what's the point of managing a $10,000 or $50,000 and you get a cumulative returns of 6% per year? It doesn't make sense, right? And that's because you are so naive, you are so scared of risking a bit of your capital. So it's usually a tricky balance of how much should I really expose. And the advice is for new traders, start with 1 to 2% per trade. With a maximum exposure of 5% in all your trades. As you develop the confidence, as you backtest, as you test out these strategies over a couple of months and they're working out for you, then you actually know how to balance out these margins and spread out a little bit of risks to one trade and cut out on this other trade. And so this is a thing that comes with training and mentorship as well. Traders really need mentorship on this skill. Yeah. It's not a skill you just hop into YouTube and see a couple of videos, and hop into that other article and tomorrow you think you're making money, which is the wrong approach to trading. Yeah. It's a risky approach. It's a risky approach. Yeah. So so that's very important for traders to really respect that. This is an industry that has its own disciplines, and the biggest one being the understanding of risk management in Forex trading. And then it's one thing getting the numbers right as to how much you're supposed to risk in a single trade and the total exposure. Then what happens after you initiate the trade? You've got it all right. Yeah. You've got the percentage right. Mm-hmm. The trade setup is there. It's clean. It gives you a risk-reward ratio of 1 to 2, 1 to 3. Perfect shot for you to take, and you're not chickening out, and you're in the trade. Then what? This is one bit of risk management. Then what? You're in the trade now. Then what?
Then you get to swim. Then now you have to know how to manage. You switch from a trader into a risk manager.
Nice.
Okay?
One.
Yeah. So you need to know, once you're in the trade, you've done your due diligence, you have known beforehand, I am willing to risk this, and you've done your math, you've got your lot size. Maybe that's something we should mention.
That's a good
before
one.
We forget.
True.
You've got your lot size, you know your stop loss distance, you're in the trade. Now, once you're in the trade, you turn from being a trader or a speculator into a risk manager. So now you need to develop the necessary skills to be able to manage this trade while you're in the trade. So given that your trade has made some profits, so maybe you are risking 50 pips and your trade is 80 pips in the money. So what should you do exactly? So there's a couple of things you could do. All of which are in our trading course. So one of the things is you may use a trailing stop.
Trailing stop loss, which is a skill of managing your trade when you are in the money. And at this point, I think it's important to discuss at what point do you engage trailing stop loss? And basically, what is trailing stop loss as far as risk management and now managing your trade when you're already in the trade? What is trailing stop loss per se? If you could explain like to a guy who doesn't have any clue about Forex trading.
Okay. So a trailing stop loss is, in simple terms, a stop loss which follows your order. Okay, only that it does not move backwards. Okay, so for example, if you are selling the market, your trailing stop will move down, considering your position moves in the money. Okay, if you're buying the market, then your trailing stop will move up, but not down again. Or if you're selling, your stop loss does not move backwards. Okay, so it's simply an order that follows the market. If the market moves X pips in your favor, your trailing stop will follow by X pips. It is for you to decide, for you to configure your trailing stop by how much it should follow your order, right? So a trailing stop, well, if you're listening to this podcast and never heard about a trailing stop, you might probably think this is, your saving grace. This is Jesus, Muhammad.
Oh,
I
wow.
needed this
Wow.
to prevent me from gaining further losses.
I honestly didn't think of it to that level, but
there's a catch.
all right,
Okay.
okay.
It takes skill and experience to know at what point should I start trailing,
Yeah.
and by how much, I want to trail my order with. As a rule of thumb, do not trail your order very closely. Like, give it some breathing space. There are many people will tell you that. Give your order some breathing space. Don't trail your order too closely, because the nature of the market is it does not move up in a straight line. Neither does it move down in a straight line. It has a sine-like wave pattern. Okay, so you don't trail your order so closely so that you prevent being stopped out, and the market still goes in your favor,
in your direction.
Yeah.
Perhaps what George is trying to just to polish up on that, trailing stop losses, you find yourself in a winning trade. You've taken a trade on the pair of Euro USD, and your risk to reward ratio was 1-2 that you had configured in that trade, and your trade is almost approaching to hit the take profit. But then you again get back into the market and you reanalyze the market and find out that actually the momentum in the market is so strong that you believe you have enough reason from reading the charts that this momentum is going to go past my take profit. And so it calls for traders to be rational enough and patient enough to not cut the profits short. This is the only rule whereby you are advised to move your stop loss and your take profit when you are in the money, when you're making money. When your trade is making money. Your trade is we call it in the money. When your trade is making money, then you're in the money. So this is the only instance whereby you can get to move your stop loss and your take profit. And then on this instance, what you do is you move your take profit further depending on your current analysis of the new movement that is that is happening in the market. And then when you move your take profit, you also move your stop loss to lock in some of your profits, which means at some point, you're actually going to be running the trade risk-free.
Oh, yes, most definitely.
Most definitely.
The only time in life that you'd probably not be facing any risk
is when you apply trailing stop losses. And trailing stop losses is so powerful in that you get to move your stop loss above your entry point because you've moved your TP further because the momentum in the market is fitting for your position. And so this is a skill called trailing stop losses. It's a whole topic on its own. Again, it's covered in our comprehensive online Forex course that we offer one-on-one mentorship. It comes with one-on-one mentorship. And as we continue to get into this topic, I'd just like to mention that this podcast is brought to you in partnership with FXPesa, which is a subsidiary of EGM Securities. And so we'll be doing a couple of series of podcasts in partnership, FourthStreet Consultants in partnership with FXPesa and EGM Securities. And so this is the first episode of the many episodes that we're going to be doing throughout the year. So you can always follow our social media pages, both for FourthStreet Consultants and as well as EGM Securities, to just get a feel of these discussions. And so we've talked about you are already in the trade. This is the element of risk management whereby you're already in the trade. We've talked about the trade is working out for you. You're applying this skill of trailing stop losses and you're smiling. Your trade is working out for you. And you're probably going to make achieve a risk to reward ratio of probably 1-5. Because remember now, the trade is favorable for you. The original risk to reward probably was 1-2, but the conditions of the market allows you to expand your trade to earn more money. What about the downside? What about the stop loss when the trade is not working for you? This is the part that most trainers and most people don't talk about. So what about when the trade is not working for you? What's the approach? Do you really wait for your stop loss to be hit? Can you apply your experience in reanalyzing the market and exit the trade before actually your stop loss is hit to lower your risk exposure in the market. What about that end?
So this is also a very sensitive matter, okay? In that with the right analysis, the right analysis should guide you when to exit your position on a loss, okay? Well, I believe that point is where you should place your stop loss, right?
Yeah.
However, we are dealing in a very uncertain and dynamic environment. The markets change as often as...
Give an example of the real time as we do this recording of this podcast today. This week has been a mayhem. It's been a nightmare in the markets. I saw another trader friend of mine tweeting that I think is gonna change from being a trader to a painter, and he's already getting tips. I got ideas, but I'm not yet convinced because I got mouths to feed. So, but then the idea is, what happens again, George? Sorry to interrupt you. What is it? What's the approach when it's on the downside? You've gone into a trade and things are not quite working for you. And remember, discipline and patience is most essence. You don't want to act in terms of a panic mood. You want to be as rational as possible. And the reason why risk management is so powerful is because if you know that you're risking only 1% of your capital, then you're most likely to be rational because you're comfortable with losing 1%. If you make a spread of 100 trades and you lose 20, that's okay. We can't avoid losses in trading. Same way we can't avoid losses in life. And so the power of risk management is it allows your mind to be clear, clarity of the mind. You won't tense. You won't wake up in the middle of the night to check up your phone. And if you're doing that, you're doing things really wrong, which is very common. If you find yourself sneaking into the markets every second, you can't concentrate, then you're doing something definitely very wrong. So that's the question now. So a trade is making a loss. It's out of the money. What is it? Do you wait until your stop loss is hit? Or do you just cut it out before your total risk amount of the 2% upon which you set the stop loss is hit? So what's the way for this?
One of the ways that you can actually become a very successful trader is cutting your losers short and letting your profits run. Okay,
sure.
It is a very important skill knowing when you're losing. Okay, you need to know when you don't have it anymore. You need to know when the bird has just slipped from your hand. So you may have your stop loss in set. You did everything right, but at this moment in time, maybe you're looking at a very significant level in the market, and a very powerful potential reversal signal has just occurred
after you
it is there in plain sight. Again, the market never does anything without throwing signs. So the signs are there, clear as day. Then you need to know when to pull the plug. If your stop loss is, sometimes we as human beings and traders in general, we tend to delay the inevitable.
It's a common trait with human beings to kind of hold it back and hope. And this really works against you, especially in Forex trading, because the market is a respecter of no man. Trade what you can see. Don't trade what you expect. I guess that's the point you're trying to... So
as soon as you see the signs are there, I also have to insist you to be able to identify the right signs, you need the right education, you need the right mentorship, you need the right background. So otherwise you will you might see things that you might think you're seeing the signs, but you're seeing things that you probably expect to see. Because if you look for anything in these markets, you will actually find it. If you expect the market to turn, then you will see some reversal signals on your own. Whatever you look for, you will get.
Actually, let me give you my real life scenario when I was starting off trading. So from my own experience, and this is something that I'll share real time with guys, in my early years as I was starting trading, I thought I've hacked this thing. I go through this YouTube video and I think, oh, wow, I didn't know about that. I'm going to apply that. Then I try it out. Then I find out these are the article about FX. Then I just bump into another trainer from whatever random place in the world who is showing the life, and I'm like, wow, this is you living the life. I made all the mistakes. I lost tons of hundreds and thousands of dollars. It was so hurtful. Then until when I really acknowledged that I need training, I need mentorship, that's when my whole career just sparked up. It's like you've seen the light and you can't afford to go back there. And then our responsibility as 4th Street Consultant is to not let you get there to what we had to encounter in our early days. And so going back to the topic of losses, I think one of the ways that you can cut down your losses before even your stop losses hit is when a reversal signal clearly happens that disqualifies your earlier judgment, then you can cut it out. That's one of the ways. But I must agree that there are some other times that you might not actually be in a position to cut the position short because the markets have not quite given you the reason. And so in such instances, you can just let the market to work out. But in other instances, and as you couple up experience, then you'll be in a position to cut your losses short before even your stop losses hit. And I just realized that the time has really flown really fast and we need to wind up. And so what we do is we take this discussion to our social media pages, and you can as well visit our website. Then we can interact some more. Then of course you can always reach us out. You can even walk into our offices. Let's have a chat. Let's tell you about our course. Let's share our journey, and then of course now we can get to interact some more. And so on behalf of FXPesa, and which is a subsidiary of EGM, we have to call it a halt at this point. And thank you so much, George. It's been a pleasure. George is a consultant at 4th Street Consultants. We all work together. So it's been a pleasure. It's been a pleasure to engage with guys.
Anytime, sir.
Anytime.
And just your friend who's about to turn into a painter, call him after this podcast. He needs to tune in.
I'll do that. I'll do that. Thanks, man. I will see you in the next episode. Thank you.